May. So cash collection is coming from cash collection budget. So total cash collection is for 30,000. And there we go. In May, we are purchasing equipment worth of 143,700. So our disbursement is 400,000 and our cash collection is for 30,000, and now we have 30,000 balance. So do we need any loan? No, we don't need any loan. Only thing is that we need to pay for our, wait a second. So we don't need any loan for May because our minimum balance is achieved 30,000. So here we go. Let's talk about our quick check here. So what is the excess cash available over disbursements for June? Here we go. Where is this 95,000 came from? Here. In June, this 30,000 balance will the opening balance here, and that is the cash collection. And we already have our disbursement here. So you see, we have the excess cash of 95,000, right? Which is basically the quick checks of our previous slide. Since we don't have for this lecture all these figures, mentioned here, I'm just gonna skip that concept checker. So I'm just going to give you the explanation that's here. So we are borrowing the loan at first of the month and we are paying back at the end of the month. So at the end of the month of the quarter, on June, you are paying back your loan. So this is a crucial point here. You are making cash budget for the quarter, right? So you borrowed the loan for a quarter. So you borrowed the loan for 50,000 here, and you have to pay 16% interest. And how much you use that 50,000? April, May, June, right? So that's why the calculation is 50,000 multiplied by 16. The period you use for money is for 3 months. And how many months are in 1 year? It's 12. So this 3 by 12 is the usage of your usage of the bank money, which is 50,000 multiplied by 16%. So answer is this 2,000. So that's your excess cash. 52,000 you prepay to the bank, and you still have 43,000 left for June, which is the ending balance, right? So if the question also mentioned that how much cash available for investment, since you maintain a policy of 30,000, so 30,000 must be in your account. So if you less 43,000 minus 30,000, answer is 13,000 left for investment in any kind of securities, or save it with the bank or whatsoever, right? So this is the usage of and how we make for cash budget. So everybody, you understand that? I know I went through this topic real fast because I know you already studied this one. So I just explained a crucial points here, and that's it. And remember that one, the making of the cash budgets, everything is here based on cash, right? So it means whether the direct material, direct labor, manufacturing overhead, selling and admin, every disbursement is free from any non-cash item. It means there is no effect of depreciation here, right? Because we are making cash budget. Everything is based on cash. Any question, guys? If no more questions, we have completed our cash budget. And now the logical point is we move to our making of financial statements, right? So let's talk about the budgeted income statement. We already know the budgeted sales. We already know all the expenses details. So it's easy for us to make the budgeted income statement, right? So with interest expense from the cash budget, Royal can prepare budgeted income statement, right? So why don't we just make the budgeted income statement right after making all the budgets, rather the cash budget? Can we make that? No, because we need to find out how much is the interest expense, and interest expense can be found out through cash budget, right? Here we go. So we know that our budgeted sales for 3 months is going to be 1 million, right? Which means, April, May, and June. This is the quarter sales. Our quarter's cost of goods sold is 499. Why? Because 4.99 is our cost of goods sold. Cost of goods sold amount, and we find out through ending inventory budget, in which we find out that the one inventory unit is equal to 4.99. So the cost of selling 100,000 units would be 100,000 multiplied by 4.99. This is 499,000. The gross margin is like here. Selling and admin expenses, we just go through the selling and administrative budget. We just pick that figure from here, and this is the quarterly figure, right? Because we are making quarterly income statement, and interest expense is 2,000, can be verified from cash budget as well. So this is our expected net income, right, guys? This is our expected net income. So I just want to confirm one thing, that the selling and administrative expense. So let's just see that. Selling and administrative expense. Here we go. So did you notice something? Oh, sorry. That in income statement, we didn't use 230,000. We used 260,000. In cash budget, we used 230,000 of the budgeted selling and admin expenses. So if you see our income statement here, we use budgeted selling and admin expenses for 260,000, because in income statement we include non-cash item, non-cash expenses, right? Depreciation. So depreciation is a part of admin and selling expenses. So that 10,000, 10,000, 10,000 for each month from April to June is a part of admin expenses. So we included that one. So remember, the point that I want to explain here is that in cash budget, every item should be measured in cash, inflow or outflow. That's it. If there is a non-cash item like depreciation, or any barter exchange system in which no money is involved, we avoid that one. But in income statement, we do include the effect of all the barter transaction gains, right? And also the non-cash expenses of like depreciation as well, right? So that is why the cash budget cash is different, or we can say that that is why net income is not equal to cash. So a layman concept is that if a company made 239,000 profit, it means 239,000 is credited in his bank account. No, because this 239,000 includes some non-cash expense. So that's why the smart managers, the financial analyst or shrewd people, they don't believe the net income. They believe cash flow. So whenever they want to invest in other companies, they seek cash flow because this net income can be inflated or can be deflated. They purposely reduce the value of like depreciation because depreciation is just a method, a number game, or they can include the inventory valuation method like LIFO, FIFO is kind of stuff, and they can decrease their cost while inflating their profits, and they can manipulate their net income. So that's why the analyst, smart people, they don't trust the income statement. Although income statement is a very valuable part, they give you too much information, but they don't trust the net income or net profit. They go to check the financial health of the company through cash flow. Okay, our last step is to prepare balance sheet. So we already finished our income statement, and for balance sheet, let's talk about that. So the Royal Company has reported the information regarding land, retained earnings, equipment, common stock, and rest of the thing is going to be filled by our budgets. So let's talk about this. So our assets, first one is cash. Cash is 43,000. It's coming from cash budget. So at the end of the June, our total cash balance was 43,000. So here we go. Account receivable is 75,000. Why? Because 25% sales of June is going to be received in July. So 25% of sales in June going to be received in July. So our accounts receivable is 75,000. Raw material inventory, similarly, it is our 11, which means like I think 20% or 10% of the raw material for the next month we need to have to make like ending inventory, if you recall our previous lecture, and that would be 11,500 pounds. In value, you multiply with 0.4 per pound, answer would be 4,600. Finished goods inventory, the inventory that we have 5,000 units, our per unit cost is 4.99, right? Land value is already given, equipment value is already given. So in equipment, remember this is 347, and they have given us the value of 175. So this is 347,000, right? 367,000. 367,000. So what caused this equipment figure to increase? Let's go back to our cash budget, and in which we saw that